Nearing a market bottom. Let's bring in our panel. Joining me now, Jeff Kleintop of LPL Financial, Michael Pansner, author of Financial Armageddon, Kudlow and Company contributor as well, Jerry Bowyer of Benchmark Financial Network and the National Review Online, plus Kevin Kerr, president of Kerr Trading and editor of Research Trader Alert. Guys, good to see you. We really appreciate it. Jeff, let me start with you. So many signs to many people this week that we are looking at a bottom, whether it's a retesting of the lows, whether it was the cataclysmic event with Bear Stearns. What do you think? Have we hit a bottom?
Yeah, you bet, Michelle. I think these are the classic signs of a bottom. You know, it's once inflation starts to roll over and that stocks really begin to price in the other side. And that's exactly what we've seen here with oil prices breaking down, gold coming down, and the dollar beginning to rally. I think we've finally gotten that break in inflation we were looking for, leading to rising PEs and a return to early cyclical leadership. Look for the consumer discretionary sector and technology to lead from here.
Michael, what do you think? Is this the beginning of finally the end of the crisis?
I think you have that the other way around. It's the beginning of the end. I think people making the argument now that they see a bottom. In fact, every time you pick up a Newswire story now, it's everyone's seeing a new sign of a bottom. Richard Bowyer said end of the financial crisis. Financials rallying. We had upgrades in Fannie Mae and Freddie Mac, and on the basis that the capital's been reduced, it's all bad news to me.
It's all bad news? What is so bad?
Well, because at bottoms, people don't even see them coming, and that's the tradition. That's the way markets have worked for hundreds of years. When you have everyone running around now that they see the light at the end of the tunnel, it means they see an oncoming freight train.
Jerry, what do you make of the move in commodities? Is that telling us anything about whether we're at a bottom?
Yeah, well, it's telling us that the commodities are a bubble, that they were way overpriced. Look, the Fed has a tendency to go too far. When they put liquidity into the system, they go too far. The Fed did that. You know, in the late 90s, they created a stock market bubble. Then in 2003, they created a housing market bubble. With their recent cuts, which have gone too far, they've created a commodities bubble. They're done cutting, in my opinion, so the bubble is coming to an end.
Kevin, weigh in here. What's your position?
Well, I think, first of all, we have to get a couple things straight. I would not consider this move in the dollar a rally, considering, you know, basically we've seen, you know, just historic lows. Gold certainly was overpriced. It was parabolic move to, you know, 1030. Of course, we're going to get a correction. It's only normal after the rise we've had. Oil was certainly overpriced. I just said this last week on this program. We expected a correction at any time. We're getting it. Maybe too much to the downside now. It certainly is related to the weakness in the dollar that we've seen such speculative bubble in the higher end of the commodities prices. But there is real demand in many of these commodities. And I don't think you can lump all the commodities.
So what's the bottom line that you're saying? You think this is what, a decline in a secular bull market?
This is a large correction, technical correction more than anything. And certainly there's a lot more speculative money than there's ever been in these markets. So when it goes out dramatically. It's going to come back in just as dramatically.
Who else is willing to step in here on the commodities, or is everybody? Who is? Go ahead.
I think what you saw in the commodities this week actually marked the end of the era of leveraged speculation, and I think it sets in motion the next leg of financial Armageddon, I'm afraid.
Right, so you're willing to buy, though, the commodities at this point after the pullback?
No, I think they have been bid up on the back of financial excesses. I think that is now becoming unwound, and I think they're going to fall into line with the broader deflationary trends. Contrary to what everyone else is arguing about inflation, the deflationary trends from a bursting credit bubble are going to have their impact on commodities and everything else.
Michael, is there anything you would buy?
Actually, I'm a little bullish on the dollar, to be honest with you. Partly as a contrarian trade and partly as a play on safe haven money fleeing to safer shores.
Go ahead, get in there, Jeff.
I think he'd buy shotguns and propane tanks. That's the way Michael's talking. Listen, the Fed has figured out. It took a while for them to figure out what's going on, but they figured out how to do this. Using the discount window, they can put money where it's needed. They don't have to flood the whole economy through open market operations, which is killing the dollar and driving oil and driving gold up. You know, assuming Ron Paul doesn't actually abolish the Fed sometime in the near future, then I think they've got the right formula, which is no more rate cuts. If they can put in liquidity to the places where it's needed without flooding the whole world. And in that environment, I see no reason for $1,000 gold.
Jeff, how do you feel about the moves from the Fed this week?
Yeah, I think they were very effective. The Fed's taking more of a rifle approach to providing liquidity where it's needed than the shotgun approach of simply lowering the Fed funds rate, which, as was pointed out, continues to hurt the dollar. So the fact that the Fed's being a little bit more cautious here about cutting rates, we got 75 instead of 100, maybe we get another 25 or another 50 out of the Fed, but that's going to lead to some support for the dollar because the ECB has a lot further to go. Their policy rate's at 4%. That's going to come down. That's going to continue this, I don't want to say rally in the dollar, but a little bit of strength, a little bit of support, which means commodities may have some more downside.
Jerry, you don't agree that these were historic and great moves by the Fed to finally attack the problem, suck some of those mortgages that had been clogging the pipes, get them out of the system, and finally get liquidity to where it was needed?
I think that coming down from 5 1/4, say, to 4 was right. They had been too tight. But you can go too far, and they almost always do go too far. Too loose in 99, too tight in 2001, too loose in 2001, 2003, too tight. That's what they always do. Central banks always do that. But in this particular case, I think they figured out how to do it. They've used the discount window. For Pete's sake, that's why the Fed was created. It wasn't created mainly to manage the money supply. It was created mainly to be the lender of last resort, and that's what they figured out that they're supposed to do.
See, Michael, everything's peachy.
It's all looking rosy. It's hard for me to feel anything other than bearish, I'm afraid. But in terms of the Fed, I think your later guest, Ron Paul, and I think others like Jim Rogers have really questioned whether the Fed has a grip on the situation. Frankly, they seem to be very reactive. They seem to be breaking their own rules. They seem to be flying by the seat of their pants.
No, I've got to disagree with you on that. Listen, the Fed has been very innovative here. They've done some tremendously innovative things. The dealer credit facility, the TAF itself,
but it's always the reaction. It's never in anticipation.
Oh, I disagree. I think Bernanke deserves a huge amount of credit for diffusing this Bear Stearns collapse. I mean, as much as Greenspan got credit for the orderly deleveraging of LTCM back in 1998. Heck, he got the Maestro moniker for that. If this circus works out, we ought to call Bernanke the ringleader.
Michael, what's the right rate? Where should they be? Where should they be? Lower? How much lower?
In what? Rates are you asking? Or?
Yeah, the Fed funds rate. Where should they be? 2 1/4
Well, first
is
of
low
all,
enough?
I think the market should set interest rates. That's the first issue. So the whole debate about whether the Fed should be doing it or the market.
Okay, but that's another reality.
Well,
what do we do right now in the real world?
I think they're going to keep cutting rates. There's no doubt.
Where should they be? What should if Michael Panzer is the head of the Fed, apart from resigning and abolishing it, where would you put interest rates?
I would mirror the market because, in fact, the market is what rules in the ultimately.
All right, well, what's the number?
And what does that mean? If you mirrored the market today, the number would be?
I don't know, 3%. How's that?
Well, wait a minute. You're saying deflation, and now you want them to tighten? It doesn't make any sense.
I'm not saying I want them to do anything. I'm saying deflationary forces are swirling, and whether the Fed acts now and essentially adjusts the rate up or down is irrelevant.
Kevin,
okay, so
you know what I'm trying to figure out? What all you guys are arguing about what the Fed should be doing or whether it should be abolished is how this affects the wheat, corn, soybean markets where we see huge global demand. This crop isn't even in the ground yet. And you're telling me that this commodity is just going to drop off the face of the earth?
Let me ask you this.
No, but it's not going to be this high.
How do you know? It isn't even in the ground yet. How do you know it's a fundamental commodity? It has nothing to do with the Fed.
Listen, the world population hasn't doubled in the past year, so it's not all. It's not all demand.
But China's lost about 30% of their arable farmland. There's huge demand. There's no doubt that there's huge pent-up demand for many of these commodities.
But
it has nothing to do with the
Kevin,
Fed.
that underlying
trend,
trend that you're talking about when it comes to China and India, I hear it all the time, but it's going to take decades before those billion people emerge from poverty. I mean, don't you agree you could have a short-term decline, major decline in the price of commodities just because they've bubbled up so much, and yet you go out further on the curve, maybe 4 or 5 years down the curve?
Yeah, absolutely. Longer term, there's going to be these swings. And again, last week I was saying we're due for a correction. I agree with many of the gentlemen here that a lot of these commodities were overpriced. It was completely detached from fundamentals. Now back down at these levels, we are back to a reasonable era where we can say, okay, now we can actually look at the fundamentals again. Gold and oil, these are different commodities than the soft and agricultural commodities. There is significant demand. Yes, it will take time to get to those kind of really out-of-sight levels that you hear about all the time, but we are growing every year. We have a growing population, middle class, worldwide that is growing and demanding a lot of these soft and ag commodities. It's a fact.
Guys, thank you. We appreciate it. Have a great long weekend.
Thanks, Michelle.
See you, Michelle.
Jeff Kleintop, Michael Pansner, Jerry Bowyer, and Kevin Kerr. Coming up, Treasury Secretary Hank Paulson meeting with Abu Dhabi and Singapore officials to talk about sovereign wealth funds. We'll get the details straight from the Treasury Department. And should the Fed just be abolished? We're going to debate bringing back the gold standard with Republican presidential candidate Ron Paul. Plus, would a President Obama mean disaster for the oil industry? Our dynamic duo, Bob Reich and Steve Moore, debate that question. Plus, the Hillary papers. Is she really as White House ready as she claims? We're for keeping America great and prosperous. Kudlow and Company's coming right back.